webinar series of EGROW Foundation. As you know, EGROW Foundation is a research-based policy think tank, about 5 years old, and this webinar series is about 3 years old. When we started the webinar series, we had in mind a very clear objective of talking about India and global contemporary issues and bringing in a blend of scholars from India and abroad. We have been very, very fortunate that we have had that blend exceedingly well. We have had foreigners come and speak, and we have Indians working abroad come and speak, and we have had scholars within our country come and speak. So that blend has worked very well. We have been very fortunate. 2 Nobel laureates also spoke here. And we have been also very fortunate that G20 Task Force 5 identified us and said that they would like to conduct some webinars and spread the word through us. And so we conducted about 11 webinars under Task Force 5 for G20. We are still doing that. Now, this is the series of webinars which we are doing for empowerment of women. And this will go beyond India's presidency. India's presidency, the last meeting is September 9 and 10 in Delhi, but the seminar series that we have chalked out will continue till end of November on women empowerment. And the reason is that under this Troika, our India's name continues, though the presidency will move on to Brazil, but India's name continues at least for 1 year after that. So we have been very fortunate in EGROW Foundation doing that. We have been also very fortunate that other than the webinar series, we have been also doing lots of research around COVID, which has been recognized globally as well as in our country. It is in that very context and with that very sequence, we have been talking about the financial system and the impact of COVID and the global slowdown, the aggressive interest rate increases in the US. We have been talking about the financial system, not only in India and abroad. In that very discussion, Professor Subrahmanyam had come and spoken to us about 2 months back, where he discussed these things in detail. And today we have a good friend, Ruchir Agarwal, who has done his PhD from Harvard under my very good friend, Greg Mankiw. And I envy you, Ruchir, because if I was young, I would have gone to Greg Mankiw to do my PhD. And his books on macro are so well known. So we requested Ruchir, who has just completed a fabulous paper on, and it's pretty lengthy paper, but very detailed, very rigorous paper on India's financial system. To chair the session, I requested Professor Subrahmanyam, who is at UCLA, who is a professor of finance, who is very well known, who's himself got many awards for his excellent research. And he's also got award, like he's the Anderson's Inspirational 100 alumnus. So I requested him if he can kindly chair this paper and share with us his experiences too. Both of you are pretty well known, and in the flyer and in the emails we have sent your bios. So I will not take too much time. I'm going to request Professor Subrahmanyam to take over and then conduct the proceedings as per his convenience. Professor.
Thank you so much, Charan. Just to make sure it is your show. So I was making sure that let's say 40 minutes for the presentation is okay for you, and then Q&A. Does that work, Charan? Or hello, Charan?
Perfect, Professor. That's perfect.
Yeah. Okay. Welcome to Ruchir. I haven't met him, but one day I will have the pleasure of meeting him. A pleasure to meet him virtually. So I think I also glanced at the paper. It's really a very, very detailed look at the situation, and it's very conscientious and exhaustive. Clearly shows a fine mind. So without further ado, I'll turn it over to you, Ruchir, with the note that let's say that you go on for about 40 minutes, and if anyone has a pressing clarifying question, they can ask. Otherwise, we'll hold the Q&A to the end. So let's say that we'll end at about in 40 minutes from now. So I'll turn it over to Richard now. Richard, please go ahead with your presentation.
Yes, thank you so much for having me and for the very nice introduction. I wanted to start by first addressing, who am I to be able even write a paper with a title and the content that is in this paper? How am I in a position to even dare to write a paper with a title like this? And I want to say, in many ways, the only way I could have written a paper like this is bringing together three very different parts of what I've done as an economist for almost 20 years. My academic work, which is really in macro finance, bridging the two. But also I spent until now I'm transitioning out of the IMF, but for these 12 years I've worked at the IMF. I really specialized in financial crises, and I worked in many very difficult financial crisis cases in the field, basically, during the Troika programs and many other difficult financial crisis cases. And then I was also the lead economist on India for a few years. So this paper is my attempt to bring all those tools to a very important part of the Indian economic history, in economic story. And this is my attempt to tell the story from my lens and the tools that I've had at my disposal, thanks to my experiences that I could learn in many different countries, now bringing it to India. Now, what is the goal of this paper? For me, I really have two goals here. One, when many people talk about the story of India, everyone has a different version of the story in mind, but I really want to shed light on why the financial sector is a really key part of that story, and to elevate the importance of finance in the macro story. And I hope I'll convince you and convince many more scholars and practitioners, especially younger ones, to really get into this world, because this is of first order importance for the future of India and the future of the world, because 1 in 6 people in the world are Indian. And so what's good for India is also good for the world. And the second goal for me is to really do my best to have a record of what happened when, to then hopefully so other scholars can build on that. And just like we study the Great Depression today in the US, many Indians are writing papers today about the Great Depression in 1929, and we're writing papers about the global financial crisis. And I want us to understand and take the lessons, not just for India, but also for other countries. So that's kind of the two goals I have here. Now, with that preface, if you allow me to just jump in, really the very, very, very high level question in this paper, it's starting from a quite narrow question, but a big picture question, which is, if you look at the GDP growth in India in the 2010s, on average, it was almost exactly 7%, actually. But in the last quarter before the pandemic, so the fiscal year 1920, the last quarter, growth rate fell to 2.9%. Okay, that's for many India watchers, anything below 4 is like kind of the Indian recession in a way. And so a low growth print like that is extremely interesting for us to know why. Now, if you look at investment in this time contracted basically for 3 quarters by over 4%. So that's kind of a big contract. There's an investment sector recession. There's a recession in the manufacturing sector, 2 consecutive quarters of contraction, also in the construction sector. So what happened? So the story I'm going to be painting today is a story of the role of the financial sector, but not just a qualitative story. I'll make an attempt to tell you also a quantitative reason for why small, tiny shocks in far corners of the financial system led to this large tsunami far away into the rest of the economy. That's kind of what I'm going to try to do in the 38 minutes or so I have left. In the paper does, big half of the paper is kind of does what happened, and then another half is a lot on policy. I'm going to really focus on the first part, And then we can have a longer discussion maybe in the Q&A more on the policy part of the story, because that's where I would be very curious to hear what you all have to think, because I see already on the call there are many people who have intimately experienced these episodes and have insights that I may not have put on the table for today's discussion. Okay, so we're going to talk about, the origins, and the process and the consequences of what I'm calling the financial crisis of 1820. I'm not calling it lightly. I believe there are many criteria or what one would call a financial crisis met in this period, and I'm calling it that so others can then start also building and adding to the knowledge base of what happened in these few years and in the run up to these years. And then I'm going to talk a little bit about the pandemic period and then looking ahead. Okay. Now, many of you really know this, but I just want to give you a very high level overview of what's happening in India's credit system. So any credit granting institution, basically today, about 120% of GDP worth of assets are held by a lending institution in India. Okay, in between 97 and 2002, in 25 years, that doubled. It went from roughly 60% to 120%. So that's a big growth, and this is sometimes not well appreciated by India watchers, even inside India, is how big the sector has become. And a big part of that growth really has been moving away from my mouse is not really showing up here perhaps, but basically moving away from the public sector banks part. Let me see how can I make my mouse visible. Okay, can you see my mouse here? Yes, excellent. So 25 years ago, the public sector banks was about 3 out of 4 rupees in India was kind of coming out of the public sector banks, and private banks basically grew rapidly in these 25 years, as you know. But also the story of the NBFCs, which now also include housing finance corporations. Today, about 1 in 6 rupees basically is being intermediated through the NBFC. That's a very, very rapid growth over this period. Okay, so those are the 3 big entities that we're going to be actors, or will be part of our story today, let's say. Now, there are 3 developments, what I'm going to talk to you about now, that led to this kind of the run up to that crisis. And development 1, as many of you know, and Charanji himself has written a lot on this, is kind of what happened in the 2000s. So let me say one thing. In India, every 10 years or so, infrastructure investments gets India into trouble and leads to taxpayer losses at some point. And so in the late 90s, as many of you know, the development finance institutions, 4 of them, got into trouble, and some of them were wound down and reorganized, let's say. And that left a space for others to feed to fund the growing infrastructure needs in India. And that's when the PSBs, the public sector banks, stepped in and basically started lending big time in that area. And however, a lot of those loans made by the public sector banks basically went sour by the end of the 2010s. And there was an understanding that's the issue, but it was not well, let's say, reflected in the books. Now, in any country, not just India, when you have large losses and in large publicly owned banks, especially, or loans to entities that may have public sector, it's really difficult politically sometimes to get that kind of recognized. So a big part of effort in the early 2010s was to address what's called zombie lending. Zombie lending means the loan is dead, but you're keeping it alive by kind of evergreening it. Was how do you address that problem? And so that's in that context, there was this process, what we do, what's called asset quality review, which is you go and assess the quality of the books of every institution, and then you basically reclassify those loans as non-performing or not. And here, once that process is done, there's a second process, which is called prompt corrective action, which basically means the patient is on a path to a very high cholesterol diet. The patients come to the hospital and you put the patient on a diet. So you put a corrective action. And so these banks, many of them, there were 12 banks that were put on the prompt corrective action after this AQR, which is around 2015, 16, this time. And 11 of the 12 banks were public sector banks. Okay, and so what you're seeing here now on the graph, let's look at the graph on the left side. The pink are these public banks under the PCA. They're on diet. They're not allowed to open new branches. There are restrictions on lending until they address their past sins of eating too unhealthily, doing a lot of these bad lending. And so those banks are one where the NPA, the non-performing assets, which is bad loans basically, goes up to 20% roughly. Okay, so whereas private banks, as you see, are not the ones that have sinned a lot in this 2000s period, and that's not where the problem is concentrated. Now, this is where I've so far told you finance this, but this is where macro matters. When this AQR was designed, there was not as much thinking. If you just go back to the history of the thinking there, the big focus was on getting it through politically, which is hard for any country. But the thinking was not, what does that mean on the real lending side? Now, these are nominal terms, but at this time, inflation is about 5%. So in real, you subtract 5%. On the right-hand side, look at these banks, the pink ones, the same ones, the ones on the PCA, were doing nominal lending about 20% every year growth. And they basically go to negative lending. So negative, in real terms, they're negative 5% growth. Notice that the private banks or the other banks are not stepping in to lend in their place. So that's kind of one clogging of the channel, which means that the borrower lender specificity, those borrowers who have clients coming from these PSBs, are not easily necessarily switching to some other source immediately for financing. Okay, so that's development one. I'm going to move a bit faster, but I just wanted to get us warmed up a little bit to get into the story. Yes. Okay, development two is, at this time, remember the public sector banks are now clogged. They're not lending, many of them. As you all lived through in November 6, 2016, the demonetization episode, there are many parts of the demonetization episode, but from our story, a very interesting part of it is a lot of liquidity flows into the banking system. And in the Indian context, as you know, large deposit structure is in the public sector banks. These public sector banks, many of them are not lending. Initially, they park that money with the RBI, but very quickly, they start on lending it to the shadow banks, to the non-bank financial corporations. And so here on the left panel is the growth rate of lending in pink from banks to non-banks. And basically that goes, from roughly 10% in nominal terms to 60% in a couple of years after demonetization. And on the right-hand side, basically the same version of the chart in gross exposures. And you see there basically that exposure goes from 5% of banks lending to almost 9%. Yeah. So what does that mean? The nexus between banks and non-banks deepens in this time very rapidly, and that also fuels a kind of a bubble in the non-bank sector, which we're going to see now. Okay. Third development, remember, infrastructure is now kind of getting implicated. And in India, still, if you compare to other emerging markets in the same stage of development, still large lending is collateral-based lending, as many of you know who have taken a mortgage or bought a property or land. And so quickly, financing moves into the real estate sector. Now, what you have here is direct lending to real estate companies. Remember, public banks are under diet, many of them. So green, they're basically doing no lending growth. But NBFCs and public sector, private banks are basically rapidly increasing. So within a few years, the exposure of the financial system to the real estate sector basically doubled very quickly. So these are three developments that set the stage for the crisis to come 2 years later. Okay. Now, the defaults. I'm going to talk about defaults of two entities, two non-bank financial corporations that you know well, ILFS and Divan Housing, which basically precipitates this crisis. And so let's look at that. Let me take a second to get a sip. Now, the key point I want to emphasize about these two entities, these non-bank, what is a non-bank corporation? It's obvious to many of you, but for those who may not have been so steeped in this tradition, a non-bank essentially, but not really, but essentially is not a deposit-taking institution, but is doing lending like a bank. So it's a bank on the asset side, but on the liability side is often raising money from market sources. In India, you also have a few NBFCs that have specialized deposit taking, but largely they're borrowing money from the market or from other banks and lending to the real to the real side of the economy. Now, what I want to emphasize about this ILFS is actually it's not so big. It's a medium-sized entity, let's say. It's only about 0.6% of GDP or 1.2 trillion rupees were their assets, okay? Now, one interesting thing is now we know about the Silicon Valley Bank case and how borrowing short-term and investing long-term can get an institution into trouble. This kind of a version of that, where these entities were borrowing in the commercial paper, the debentures, which is kind of medium-term debt loan market, and lending long-term into infrastructure projects. But already before the default, which happens in the September of 18, about 35%, so 1 in 3 rupees of the ILFS liability were coming due within 12 months. So already the maturity had shortened, and their leverage, which is their debt to equity ratio, was 17-1. Okay, so this is really high leverage in the Indian context, at least. And so when this group defaults, initially there was a tiny subsidiary that defaulted, but the group level default happens on September 4th of 2018. This entity was still AAA rated. So it's a shock in the system, like a safe asset in a safe financial instrument, there's a default from an institution like that. And that's a shock to the system, okay? And this is an opaque institution with 312 subsidiaries. So it kind of shocks the market, yeah? 9 months later, there's a second default from a slightly more traditional bank, which is a non-bank, which is a Divan Housing, which is kind of doing real estate lending. And so it's also roughly the same size as ILFS, about 0.6% of GDP. And it also has a very similar borrowing strategy, borrowing short-term, lending long-term. But I'm going to show you later that this second default, which is not as widely reported as the first one, in fact had maybe even bigger impact on the real economy. And we're going to talk about that, okay? Now, bulk of what I'm going to talk about next is really this sub-bullet and the sub-bullets under this sub-bullet. But as a macroeconomist, the question should be, why would default of two entities, small entities, let's say relatively small entities like these, lead to such a large macro impact as I showed you in the first slide? And that's what I want to dive into now, okay? Now, one way to think about this is look at how much credit is flowing from the savers to the borrowers. To the dream of a central banker or a dream of a macroeconomist should be finance should be as boring as possible. The ideal world is where we can get the savings to the right borrowers and we can all forget about finance and focus on what really matters in the world and the real challenges that we have to face, including the ones that parliaments around the world are trying to focus on. But unfortunately, finance has this ugly habit of becoming relevant again and again. And so this is one way to look at that. In India in the 2010s, roughly, there's about 10% of GDP in credit flow, domestic flow funds from savers to borrowers, okay, internally. I've removed the external flow here. And when the PSB basically got into trouble, that's kind of the phase one that we've looked at already, that kind of jumps down to say 2 percentage points, excuse me. But when demonetization happens, this is kind of what I'm calling the demonetization bubble. It kind of upside, inadvertent upside maybe in the short term was a lot of credit started flowing back to the real economy. And so that's kind of what happened here. But then the shocks that I'm going to talk to you about now effectively lead to a large collapse here. And I'm going to talk about why that happens. Okay, so remember this chart and we're going to come back to that. Now, the story I will tell you is what I'm calling a macro financial spiral. And basically, there's a lot of words here, so just don't read them. Listen to my words instead, just to help you guide you through this quickly. essentially the story I'm going to tell you now is these defaults of these two entities, non-banks, leads to a type of mechanism where there's a large uncertainty, flight to safety, and that kind of triggers a run on the shadow banking system, on the system that funds the non-banks, which in turn leads these financial institutions to hoard liquidity because they're not sure where they can get funding from tomorrow. So let's hold on to the cash today. And that in turn leads the borrowers, the corporates, to not be able to roll over their working capital, which kind of then leads to spreading of defaults across the supply chain, which then exaggerates the uncertainty and flight to safety. I'm going to show you now these in less in words and more in numbers going forward, okay? And basically the DHFL shock basically restarts that spiral. Now I'm going to talk about this sub-bullet in 4 sub-bullets just to walk you through how I see the story unfold, okay? First, once the default happens, there's a run on the mutual funds, okay? So many of you know well about the mutual funds, but just to give you a quick overview for those who may not be as familiar. In India, actually, the mutual fund industry is sizable, with about 25 trillion rupees, right? And it's about 15% of GDP in assets under management, roughly half of which are in debt funds and a half in money market funds, okay? The important thing I want you to take away from this slide is the exposure of the money of the mutual funds to ILFS and DHFL was only about 1/3% of their assets. So tiny exposure. And despite that, there's a large run, and I'm going to show you why, okay? Now, one way to look at that is just kind of across the trend. If you look at how much assets under management, so there's a large trend. So this detrended. Once demonetization happens, there's about 3 trillion rupees. So, 1 trillion rupees is 0.5% of GDP in India at this time. So there's about, 3 trillion rupees flows into the money market, into the mutual funds. But after the ILFS default in a month, about 35% decline in the money market mutual fund assets under management. And the same thing happens again after DHFL default. That's a tiny exposure leading to these large outflows, okay? Who are these people running? So imagine the CFO of a corporate like Bajaj Auto has placed some money in a mutual fund to manage their liquidity, and these people are just pulling, these corporate treasurers are pulling the money out. In turn, these mutual funds who are funding the NBFCs are pulling money out of the NBFCs. So that's the one way to look at that is the NBFCs issues commercial paper, which mutual funds buy, and basically this market was basically tiny a few years ago and had grown rapidly, and these two defaults basically shut down that market, okay? So, or halted that market at least. And so this is a two-sided run. The corporate treasurers and others are running on the mutual funds after the default of those institutions. Mutual funds are running on NBFCs, okay? Now, why did this happen? This is really important for us as students of economics. Why should this happen? How can a tiny exposure like that lead to such large outflows? In a way, this is very similar to the story of the run on the repo after the Lehman shock in the US in 2008 and 9. And what's happening is, this is one of the first big credit events in India. And the mutual fund industry, so I learned this from reading a lot of their kind of technical notes of what was going on here. There's two things happened. Once the default happened, each mutual fund was applying a haircut on the losses on their exposure in different ways, right? So some may apply a bigger haircut because they don't know at the end what the loss given default on their holdings of the paper of ILFS was. So they're applying different haircuts. In the mutual fund, when you pull your money out, you pull it out on the net asset value of that day. So there's a difference. If someone applies a larger haircut, you get less money back, okay? Second, not all mutual funds apply the haircut immediately. Some waited a few days because they didn't know how to do it. This essentially created an incentive to be the first mover. If I move my money out now, I can avoid getting that haircut. And so it's kind of the classic bank run dynamics, which basically, that's my explanation of why these tiny shocks led to this panic because of basically very similar dynamics to what happened on run on the repo, basically in the US. Okay, so that's my answer to the question of why that tiny shock. Now, various impact of this and ways to look at it. I'm going to just quickly show you one on the left side. Credit spreads start to spike a lot. So interbank or borrowing or borrowing in the market starts to really get troubled here. And so one way to look at that in India, if you look at the AA, AAA corporate spread, so these are non-financial corporates that issue that AAA rated or AA rated, the difference in that typically is like 50 to 100 basis points. So there's this excess interest they have to pay to borrow money from the market. After demonetization, that, let's look at the pink, that had gone from 150 basis points to about 50 basis points. So that's kind of because a lot of money was flowing into the financial system. But after these defaults, basically that even the market starts differentiating between AAA and AA. And so that cost of borrowing spikes. And that's kind of the spike in uncertainty that I mentioned earlier. Okay, very quickly, let's move to the second part of the story. Now, that's the run on the shadow banking system. What did that do to the NBFCs? These NBFCs started hoarding the liquidity and stopped lending, basically. And I'm going to show you that now. To see that, let's quickly look at what the liability structure of the NBFCs look like. The liability structure of the NBFCs before and after the defaults, okay, 17 and 19. I want you to focus on this blue and red. That's basically debt instruments, medium-term or short-term debt instruments. And that market starts collapsing. And so these entities have to now rely on other sources. So they go to banks, or actually there's some government has some incentives in the background on having DFIs start lending to them. So there's some interesting things going on there. But they're starving, basically, for liquidity. And so this is classic, Akerlof-Lemons type problem. There's asymmetric information. There's doubts on the health of every entity. And instead of expanding lending, they're basically trying to strengthen their loan book, okay? I don't have time in the shorter presentation. I thought I'll have time. I listened to like 20, 30 conference calls, earnings calls of the NBFC, talking to the investors in this time. And you can hear they're under major pressure. And everybody's basically saying, we're going to do more precautionary saving. We're going to focus on showing that our loan book is strong. We're not going to do new lending because we are not sure if we can access credit markets tomorrow for funding. So that's kind of the liquidity hoarding, okay? So far, this is after ILFS default, the problem is still restricted to the NBFC and what the shadow banking system. But after the Divan housing default, there's a spillover to the banking system. And that's really matter for the real side. And why did that happen? Now, this is what I call India's great funding imbalance. Okay, this is a key point I want to emphasize, and I make a big deal about it in the paper. What this chart shows you is net exposures of types of entities within the Indian system. Okay, so on the left, if it's 8 trillion, like mutual funds is 8 trillion rupees, that means mutual funds are lending 8 trillion rupees to other financial entities on this right-hand side. Okay, in India, there's a very peculiar situation where the public banks are safe and have an implicit guarantee. So people want to go put their deposits in the public banks so they can raise money very cheaply, right? So these are public banks here. But they are often either restricted because of the prompt corrective action or because of their business models. They're not as aggressive on the lending side. A lot of the NBFCs and private banks are doing a lot of creative lending. An example I like to give is I talked to one NBFC, they figured out how to lend to used trucks. A person has been driving a truck all their life and they say, I want to buy a used truck and do it on my own account. And these guys figured out how to lend that using that as a collateral. That's really creative. That's kind of 2 out of 3 people in India are living in rural or tier 3 type cities. And so these guys are going there, figuring out lending there, but they don't have cheap source of financing. So their asset side is strong, the liability side is weak. And on this side, the liability side is strong and the asset side is weak. Anytime there's a problem in the interbank or the money market, that creates a wedge. And so at the end of the day, the borrowers are paying that premium because of inefficiency on intermediating finance between these 2 sides of the market. So that's the great funding imbalance. Okay, and to emphasize that point, I just want to show you the private banks versus public banks liability side, basically blue is retail deposits, people like us putting money. Only 1 in 3 rupees for private banks are coming from that. Everything else, corporate deposits, market borrowing, is very easily mobile. And these guys are starving. They really have to work hard to raise the funding from them. Okay. Now, I don't want to, given the time, I'll just say quickly what happens after the Divan housing. I'm not going to go into the chart because, in the interest of time, after Divan housing default, you remember we saw this rising nexus between banks and non-banks before, after demonetization. What happens is many banks start to report NPAs and report that they have exposures to NBFCs in Q4 of 2018. And now the market starts to panic that there may be a lot of hidden bodies in the banking sector even that we don't know about. And that you see basically the public banks and the lower tier banks, basically people start avoiding them. And so this leads to what at this time in India, if you talk to RBI and a lot of analysts in 2019, they are talking about why is monetary policy transmission breaking down? RBI lowers its interest rates by 135 basis points, but borrowing rates were not coming down. And a big part of it is now private banks are basically starving for liquidity because the money markets are not lending to them, and they are raising their deposits rates to attract money. And so that's, when you have time later, I would really encourage you to go back and look at this chart. But basically, what happens is the deposit rates spike up from roughly 50 basis points to almost 200 basis points because private banks are really struggling to raise money. They start raising the deposits, and they're the marginal price setter now, which leads to other prices, deposit rates to go up. And so another way to see this whole problem of liquidity hoarding is banks now, private banks especially. You remember, so in India, the biggest liquidity facility, the standard one is liquidity adjustment facility, the RBI. Basically, banks keeping money there is your closet. And after demonetization, this was in balance, and that kind of went up to Hello, Hannah, please, could you kindly mute? Thank you. So that kind of demonetization, liquidity jumps up into the system. This is when they pull it down, the banks start lending to NBFCs again. And after the ILFS default, banks are still immune. They're not having the problems. But after the DHFL default, concerns about exposures of banks to NBFCs goes up. And this is when banks facing difficult funding environment and they start hoarding liquidity. Every liquidity you're hoarding, you're not lending to the real estate sector. That causes a problem in the real estate sector, okay? So if you have not followed the story so far, if you're just joining, in one picture, the story I've painted so far is this, in 8 steps. Step 1, so blue is the dreams of the macroeconomists, right? Lenders and borrowers. All pinks are finance entities. After the AQR and PCA, public sector banks basically clog their lending to the private sector, to the real economy. That's step 1. Step 2, after demonetization, the informal money lending basically gets interrupted. Then, after the 2 defaults, there's a 2-sided run on the mutual funds, right? The corporate treasurers run on the mutual funds run on potentially troubled NBFCs, so 3 and 4. Step 5, because of liquidity hoarding, the NBFC stop lend. This channel gets clogged to the real sector. Step 6 and 7 is then once DHFL defaults, private sector start getting into trouble, and capital markets stop lending basically to the private banks. Sorry, yes. So that's kind of what's happening, and that's the story of how all channels by 19 starts getting clogged and then having a real sector impact. Very quickly, last 3-4 slides only. Essentially, there are various ways to measure this, but a large credit deficit emerges. India is not creating as much credit as it should, and one way to look at that is the MSME sector, which is kind of innocent bystander here, really gets crushed. So all the different entities basically stop lending one by one to them, and in real terms, they have negative lending basically. Within 2 years, going from about 15% lending to basically 0. And And the credit sensitive sector, so this is going back to the first chart I showed you, look at manufacturing, growth here is about 9%, 8.9% in this quarter, total growth, and manufacturing was 2% contribution. And by the last quarter of 1920, basically we are back to 2.9%, and that recession in the manufacturing sector that I talked about. Last, in a way, what happened during the pandemic, a big part of the paper is what happened during the pandemic. I have just one slide really on that. I think at the end of the day, the authorities did a lot of extremely interesting things, some very, very good, some that there invites a lot of debate and questions. And one thing I just want to emphasize, the RBI's liquidity strategy at this time was quite conservative. They did not want to go directly lend to the troubled NBFCs. Their strategy was to give money to the public, to the banks, private and public banks, through open market operations, and then encourage them to on-lend to NBFCs. But this effectively meant there was excess aggregate liquidity, but still big pockets within the NBFC sector that was, and the private banks sometimes, that were starved of liquidity. And that was a big issue. At the end, if you take note of where we are 10 years of this repair process, AQR, response to the two defaults, and then the COVID, all the major measures that happened, I would say one could give the financial sector a bill of conditional clean health today. There's a big improvement across capital liquidity positions. There's a lot of interesting aggressive growth happening in fintechs, potentially in the fintech space. There's a lot of interesting things happening now. But I want to emphasize for us students of finance and economics, one also needs to ask, this 10 years of repair, what was the lost growth, cost of lost growth in this period? And could we have done it in a way without that large macro cost by taking into account the relationship of borrower-lender specificity? And so the last slide basically is looking ahead and some themes for our discussion. I want to basically leave you with 5 big thoughts here, big picture thoughts. I really want to emphasize that finance is central to India's growth story. And I really hope more people will study this topic and elucidate different elements of the very rich financial sector in India and why it matters for the average citizen. Second, there was this concept that survival of the fittest. Why do we support entities that may have made a mistake? Let them die. I think this is a very dangerous idea when it comes to the financial system, because every lender has some unique borrower relationships. And if that lender dies, those relationships may die with them. And we need to really understand how there is a readjustment of that relationship with new lenders. If we don't think about that, we may have large costs anytime we're doing large restructuring in the sector. I've already mentioned this role of RBI's lender of last resort. Eventually, in COVID in May 2020, they did create a special purpose vehicle to lend directly to NBFCs. And a question for me as a historian of this period would be, why could we not do it before? What are the political economy considerations and constraints? And I had several conversations with colleagues there on this. And then rethinking infrastructure finance. And as I said, every 10 years or so, India gets into trouble and taxpayers have to pay a cost one way or the other because of infrastructure lending. And we need to really figure this out. There's a large number of roads and railroads and ports and other things that need to be built for India's growth trajectory. But we really need to figure out how to do it in a way that is efficient. And now the new model now is going back to doing a lot of lending directly through the books of the Ministry of Finance and also through some of these state-owned enterprises. And it's each of that also has its own complications. We need to really engage together as a community to think about how can we do it better. And lastly, the great funding imbalance. Honestly, if we can find a way to improve cheaper funding for the entities in India that are doing this, going to the real people of India, where most of the people are living, who are unbanked. If we can get cheap funding for them, we can totally change the lives of many people who are still outside the purview of the formal financial sector. So please let me stop there and happy to take comments, questions, and or criticisms as well. Thank you. Yeah.
Thank you. Thank you so much, Ruchir, for a great presentation. Really learned a lot. So the process is going to be that anyone can ask questions, but here's the thing, please keep the questions short so that we can maximize participation and minimize follow-ups. And so that's all I have to ask you. Please, Ruchir, handle the questions. Anyone who wants to have a question for Ruchir, please go ahead and ask. Okay, please. I would prefer that you unmute yourself and ask it verbally because reading chats takes time. You have limited time. Please unmute and ask the question verbally. Charan, please go ahead. Yeah, please.
Ruchir, excellent presentation, and as luck would have it, you've spoken about the ILFS and the Divan housing, and these are really, really important ones. I totally agree with you. My quick question is, according to you, do you think demonetization played a critical role in precipitating a situation? Or you think that even without demonetization, this would have happened? And secondly, do you think that the Reserve Bank cycle of interest rate missed the story that you have just narrated?
Do it one by one. Let's take 3 questions maybe, and then we do it block so we can, yeah.
Ruchir, I think that we shouldn't waste time and just answer them as they show because.
Okay, got you. So in the interest of time, I think you're pressing me on both very important issues. Let me say, in short, the answer is yes and yes. Slightly longer, quickly, is on demonetization. It's a good lesson for any policy anywhere in the world. Any action of that nature has a lot of unintended consequences. And one of the really large unintended consequences was basically the very rapid growth of the non-bank sector. And I think the space at which the regulators within RBI were even overseeing the sector were not ready. They were getting ready. And so this kind of surprised them. And so there are a lot of events happen, including in the money market side for SEBI, that basically precipitated a very quick run. So I would say yes. And in many ways, those growth boosts of those years are kind of bubbly growth boosts because financing flowing in 17, 18. And there are people who are with the cottage industry of people trying to create a growth cost of demonetization. And sometimes they're disappointed because they don't find large costs. But part of it actually is also the general equilibrium. There's capital flows going in. And so there's a lot of things changing. And so, yes, demonetization, if it not happened, we would have very different structure of the financial system. On the RBI, I think it's very hard. That's another point. When you're setting rates, your primary mandate is the inflation mandate plus in the RBI's case, let's say this weighted mandate, and there were actually really a lot of internal debates at the RBI. Why they cut rates by 135 basis points, but why is not working? And so they were considering. But what people missed, I would say, is the role of liquidity, the role of the financial sector. When you're thinking about the borrowing cost, at the end, the borrowing costs were not coming down. And my conjecture and a claim I'm making in the paper is, if they had done direct targeted lending to the NBFCs and done a diagnostic of the top 50 NBFCs and give them a clean sheet like they did the AQR, but a mini one, that would be we would be in a very different world, very, very different world.
Anyone else? Okay, so then if nobody has a question, then I have a question. As you know, one of the important aspects of this particular government has been to actually jumpstart infrastructure. And the problem in this case is like, how do you get funding for all these projects? All these expressways have to come from somewhere. And the Golden Quadrilateral has to be funded from somewhere. The Lucknow-Agra Expressway has to be funded from somewhere. So one question would be the real effects of setting up these types of entities which operate in a dubious gray zone, but they also get the government's objectives accomplished and the infrastructure does really move along. So my question for you is that it's a little bit of a complex thing to trade off the real effects against the financial aspects of not operating in a proper transparent zone. And similarly to the Dewan housing too, that you want to provide housing. It's like similar to the Fannie Mae, Freddie Mae type objectives. And again, there are real effects. So I was wondering what your position was on the real versus financial effects of these types of gray zone activities that have the blessings of the government, actually, don't they?
Why are you calling them gray zone? Just to understand.
Gray zones because, as we saw, the regulation was loose, right? That's what you're saying, that the regulation of these entities was loose. That is to say, they got into trouble because they were making all these, undocumented loans, and some of these officers took loans out to themselves and in one of those situations, right? Like Dewan housing and so I recall reading. So gray zones in the sense that they're loosely regulated, right?
Okay, so the way, let me say, understand. In a way, I would say I want to separate two things.
Yes.
One, what India needs. Forget about the financing. India needs a lot of infrastructure investment.
Correct.
And countries at the same level of growth in sub-Saharan Africa. That's kind of the big story, going to be the big story of the next 10, 20 years, is large infrastructure and also kind of the green composition of that. Now, to me, this is a problem that we've not figured out well for emerging markets, is how do we do it first with good governance, so no fraud and good allocation. We're doing the right project selection. How do we do it by diversifying the risk that is held by multiple entities and not by concentrated in publicly owned enterprises, either a development bank or a public sector bank? And the answer to these questions has several elements. One, there's a lot of rethinking the RBI has done on supervision, and they really moved up a lot on the supervisory side. They have new scale-based supervision, and it's really, I would really, there's so much wisdom in each pocket of RBI that I've learned from, and I would say the problem is a lot of that does not get the macro lens. So we need to get the macroeconomists to understand that and emphasize the importance of that. Second, there's a lot of work going on in India on development of the bond markets, right? And this is kind of a issue of intermediation. Can we distribute the risk in a way? But that also requires improvements in the rating agencies. And so all that maturity has to go lockstep. And lastly, and these are issues of beyond financial sector, the national security concerns and other things, but external holding of the debt. In other countries, there's more openness of the financial system. So part of that can get diversified. And also that brings more oversight and international best practices. And so India is still figuring out. So I think all of those things, and my hope is, one, we can get together as a community to start putting together that guide and the best practices, because that's kind of a big welfare relevant. Otherwise, taxpayers basically foot the bill.
Absolutely. Great. Fantastic answer. Brilliant. Thank you so much. Anyone else?
Professor Subrahmanyam, if nobody has a question, can I ask?
I think Dr. Kurian.
Dr. Kurian has a question, Charan. Please wait.
Sure.
Please, Dr. Kurian.
Am I audible?
Yes.
Okay. I have 3 points. One about, you referred it to micro, small and medium enterprises like that. So my question is, from 1969 bank nationalization onwards, our main objective of finance was inclusive finance. Where are we now? That is question number 1. Number 2, we know that non-resident Indians do play a very important role in our banking industry and finance. And what about their contribution? How do you evaluate? And my third question is, I can raise the third question. The third question is, all over the world we find governments are borrowing and borrowing. America is the highest borrower in the world. And there is also a strange phenomenon that more developed countries are borrowing at relatively lower rates of interest, whereas developing countries have to borrow at relatively higher interest. And in the case of India also, our borrowing is also going up. So in this external financial environment scenario, how do you view India's present status? Thank you very much again for your very excellent inducing presentation. Thank you.
These are not easy ones, but I will dare to answer them. First is about where are we in the history of inclusive finance in India. I want to make one point there. 1 in 4 Indians live in 2 states, Bihar and Uttar Pradesh. Means 1 in 25 people in the world live in those 2 states. Yes. Now, if you look at the difference in income, when these states, look at the biggest city in Bihar, right? How many big cities are there? If Bihar was a country, it would have many different city structures. But because of the dynamics, there's a migration pattern where often the males have to go to places of work, but families are staying back still. So a challenge for India, which is very unique in a way, is how either you move the people to opportunity, the families, not just one member, or you move opportunities to the people. Now, if you look at depth of not inclusion, whether you have bank account or not, but whether you can actually get a loan. If you look at credit to GDP by state, I have a chart in the paper. We are in a place which is large gaps that have persisted. There's some improvement, but 3 times differences in credit to GDP ratios. If you look at so on inclusion, I want to separate inclusion from an idea of having a bank account from access to credit. In this context, I do think there is a lot of promise. Until now, in the UPI system, we were not allowing credit granting. But with the new push to a digital stack, there is a promise. We don't know, but there's a promise that maybe that we can have more access, more predictive analytics to, if I am paying my monthly rent, somehow if I can signal to a borrower that I'm current on that, it can change my access, independent of what my last name is or where I am living or is my behavior. And I hope that is the big, I would say. So the story, answer your question 1, is not over. And I think the big part of the chapter is to be written. And we need to, it's our duty as economists and financial sector experts to get that right. 2, on the role of NRI. I don't know if that's really that important. I think, with 1.4 billion, you already have enough people within the boundaries. So, but for me, what's really important, I would say, is there is, India is relatively closed from a financial point of view. How much external borrowing is happening, how much non-resident deposits are there is relatively closed. Even the foreign banks that are about 5% of GDP in assets are really doing very narrow specialized activities. I think what we need to figure out, at least I'm not very well positioned to answer that, but one thing I want to see more of is learning from the international best practice. And so a cost of being relatively closed is a lot of those systems are duplicated in a way that is very India specific. So like Basel regulations has a very special transposition in India, for example. And so it's not really about non-resident Indians, but having some more healthy participation of foreign creditors or practitioners can bring in oversight and practices that change, that pushes, and especially in the new digital fintech lending space, I would say. And your last question is, could you give me one keyword so it sparks a neuron in my brain?
Lending at high interest rates.
Yes, very good. And that kind of is connected to the point 2 is look at what happened after the Silicon Valley Bank shock. That's inadvertently had some spillovers in Europe, but India was relatively insulated because, it's relatively closed. And also it had addressed some of the bad actors already in the last 4 or 5 years. So a benefit of that is you are not exposed to as many spillovers, but exactly as you're saying, one of the costs is you may sometimes have a premium in the domestic cost of borrowing. And this goes back to question by Charanji on the RBI rates. There's a discussion on are the real rates too high or not. People have written a lot on that. And I think having more external capital flows can change very much the answer to that question, basically. Yeah.
Thank you so much, Ruchir. Before we go to Charan, does anyone else have a really quick question? Because Charan has one follow-up. Okay, Charan, please go ahead. Quick.
So my question is, Ruchir, you've done an analysis, and I didn't read your bio, but I know you have worked extensively in various countries which have faced crisis. So in that sense, quote unquote, you're a crisis expert now. Now, what happened in the ILFS and the Diwan housing, and you partly mentioned it now, many other NBFCs got a lesson and they corrected themselves. So many times I think as a regulator, as a supervisor, it is better you let them face the music and then everyone else recovers, solidifies, takes the remedial measures, tightens the regulatory measures, does something on governance. So given the governance norms in the NBFCs, looking back, if you have to do a balance sheet analysis, would you not say that, okay, that corrective measure helped others to strengthen themselves? And similarly, if I have to do a balance sheet analysis of demonetization, I would say much had been done. The flak has been removed after that. And now the system is moving more dynamically the way it should have been moving. Until then, it was so much artificial fat on the system. What would be your view on these two observations?
In a way, you're trying to find the silver lining in crises, and there's always some. And on your first point, and I do think a lot of this paper could not have been written in many other countries because there's not a lot of thinking already happening within pockets of India. RBI has done is incredible amount of reports the different teams are putting out. And so part of what I'm doing is putting together those stories. There's SEBI, there's Mutual Fund of India Association reports. There's a lot of information the analysts have. And I think if you look at the changes that have happened on regulation side, I've already mentioned a few, is really rapid. When I updated the paper last month, I was trying to figure out, I many things I was recommending I removed because they were done. And so I was very encouraged to see that. Point one. But point two is your, could you tell me a keyword again? Sorry, I had formulated.
What I'm trying to say is the demonetization, the way it happened and the timing of it, was it removing the flak from the system? Because much had been done on unaccounted and nothing was coming. And so now the system is leaner and better.
Yes, but let me say something very important here, okay? And this is a bit controversial, so I want to be careful in how I frame it. Now, when ILFS had got into trouble, the person appointed to be the administrator to wound down ILFS was a head of a big private bank in India. Okay, and that person was really one of the most experienced people in the industry and would be a natural candidate. But one of the things folks like him and others were saying, were pushing this idea of Darwinian economics. They're saying we should have survival of the fittest. We should let the weak ones die. Now, there is a conflict of interest where if you let smaller entities die, the bigger entities grow bigger. And that's kind of what happened. Even after Silicon Valley Bank failed, the bigger banks, JP Morgan, Bank of America, their deposits grew. And that's kind of what happened in India. Now, for me, that is a that thinking can apply in many sectors, but it's very dangerous to think about it in the case of financial market, credit markets, because credit is a lot about relationships. You all know someone, every time you go into a bank, you have an ongoing relationship with these entities. So yes, RBI withdrew license of over 10,500 NBFCs in 2 years, okay? I collected that data and I saw. And many of them should have been withdrawn. And your point is that's actually a good thing. But what I want, anytime any entity in the world, any regulator is doing that, I want them to also talk to the macroeconomists and think about what does that mean from the lending landscape to the real economy. So yes, fat is removed, but can the patient still walk as fast as they could? Do they have the same strength or not? And so that's my main point on this aspect. We should not just look at the benefit, but there's always a cost of these things. And these costs are very large because of specificity of borrower-lender relationships, especially in India.
Okay, thank you. Any last thoughts? Okay. All right. Well, thank you, Ruchir. Thank you, Charan. Thank you, Ruchir, in particular, for a brilliant presentation, teaching us things we didn't exactly know, at least as NRI. I wasn't aware of many of these facts, but I'm sure we learned a lot. And thank you very much for making the very lucid presentation and the answers to those questions. So, Charan, can we conclude the session at this time, please?
Yeah,
Or-
Subra,
Yeah.
I just want to make some housekeeping announcements.
Please. And then you can close the session. Please go
Okay.
ahead.
So let me just make 2 or 3 housekeeping announcements. Next Friday, we have a World Bank consultant, Ms. Nikita Singla, speaking to us on, as I mentioned to you, we are doing the Women's Empowerment series along. So she's going to be speaking on women's inclusion in India's trade ecosystem. The timing will be 4:30 to 5:30. I would invite all of you to please come and participate. And she has done lots of good work, and that seminar also would be a very a good learning experience for all of us. The today's seminar, I must mention, was really path-breaking, as you know, and Ruchir's extensive work in his very paper is reflective of that. And then, of course, with Professor Subrahmanyam joining in, it was such a good interaction. The recording of this will be available tomorrow by noon on our website, and I'm sure many of you would like to listen to it again. I would myself be listening to it again because going to the genesis of the problem is what Ruchir has attempted and what Professor Subrahmanyam has sort of tried to bring it out. That's not that analysis is not easy. And though there have been economists like me who have been trying to look at the cost benefit analysis of these initiatives, especially demonetization, my own feeling is it has a, yes, short-term big cost, but long-term benefits are there. But as Ruchir has just mentioned, if the patient can't walk or collapses, then what long-term benefit are you really looking at? So I think a hallmark of a good webinar is the thinking that it triggers. And Ruchir's presentation today and interventions by Professor, I think have triggered many thoughts in the mind of all of us. So I'm going to be listening to this again. I'm sure you would like to, your students and friends and policymakers in your country and in our country like to listen to this. So the presentation will be available online tomorrow. Once again, let me thank profusely Ruchir for agreeing to do this. I know you are in the midst of transition and still you agreed. And thank you so much, Professor Subrahmanyam, to have agreed to chair this. I know I gave you a very short notice, but I think I was fortunate that you agreed finally and we could do it. So this is the way we would probably be taking the thoughts to the policymakers, the best minds coming together, talking and discussing these issues threadbare in an academic environment. So once again, thanks to the participants for making it so good and rich, and hope so you will continue to be with us in our journey on these contemporary issues, policy-oriented webinars. With that, wishing you a great weekend and looking forward to seeing you all next week. Thank you.
Thank you, Charan. Thank you very much all. Thanks, Ruchir, in particular. Thank you. Bye-bye. Thank you.